Welcome, I am Ernie Goss, research faculty member here with Craig School of Business here at Fresno State University in beautiful Fresno, California. And today I'm going to report on the San Joaquin, our survey of the San Joaquin Valley, and entitled, we call it the San Joaquin Index, Business Conditions Index. So what does the index say for the month of September? Because here we are, first business day of October, and I'm reporting on business conditions for the month of September for the four-county metropolitan area, again called the San Joaquin Valley Index, Business Conditions Index. Up above 50, growth neutral 50 for the 22nd straight month. Very good. The index was 55.0. That's a strong number. That's a pretty strong number. I won't call it extra strong, but strong. Up from August 53.9, so moving in the right direction. Employment growth is running about 2.8%. Now for the non-economists that doesn't mean a lot, but for an economist that's very good. Year-over-year growth of 2.8%. We're probably anything above 1.5 is very strong. So that's good. Construction is sort of moving sideways. Manufacturing likewise sideways. Strong dollars having a negative impact on the manufacturing sector in the four-county area. Now here, let me bring up a chart that shows you the index, and you'll see it's up and well above the national number. There in red, you see the San Joaquin Valley Index, and then you see in blue there the U.S. number. The U.S. number for the month of September will come out later on this morning, but I expect it to be weaker. I don't think, it's not going to hold up well against the San Joaquin Valley number, and that's good for the San Joaquin Valley economy and what we're seeing and what we're likely to see in the weeks and months ahead. Inflation gauge sinks for the month. It sinks from 47.6 in August, and that was a weak number, to 46.8 in September. So these are the inflation's coming down, inflationary pressures. In fact, it's negative now, at least at the wholesale level, and that's a concern for some. Now, I'm not that concerned. The Federal Reserve is concerned, and they are, of course, the ones that set the interest rates, not Ernie Goss, so the Federal Open Market Committee, when they meet again on the 27th and 28th of October. So, export order numbers were at 40.0. Again, that's well below growth neutral, not good. Now, what to watch for next month? Now, in terms of looking forward to next month, keep an eye on the jobs number. Now, I know I've said this many times. It comes out October. This will come out October the 2nd. Now, that's this Friday, of course. And look at that number. Watch the wage number in there. Look at the jobs added. Look at the unemployment rate. The unemployment rate may come down even more. Jobs number may be as high as 200,000. That's very good and very strong. And that's just going to put pressure on the Fed to raise rates again, raise rates when they meet on the 27th and 28th. And that's my next thing to keep an eye on. Watch for the Open Market Committee. That's a FOMC, Federal Open Market Committee. They meet on October 27th and 28th. I think they need to get off of these crisis interest rates. We're not in a crisis, economic crisis now, and certainly not in the San Joaquin Valley, at least according to our numbers, and I think the government numbers that come out later will back that up. Keep an eye on the core CPI. This core CPI comes out on October the 15th. Now, what's the core CPI? That's when you take out food and energy. That number's been running about 1.6%. If it comes down, that's my concern. If it comes down below, then you're probably going to have the Federal Reserve getting squishy on us. I'll use a non-technical term there, squishy. Now, what are the risks? In other words, if everything's smooth sailing, at least reasonably smooth sailing, of course in California a lot of weather issues, but our surveys show that those are not stymieing the economy. U.S. stock market, believe it or not, I'm sorry to say the Federal Reserve seems to be keeping an eye on the stock market. I think they need to look at the economy, the real economy, not the stock market, to get a gauge on what to do in terms of interest rates. Look at short-term yields on treasuries. Keep an eye on those. Those would be anything less than 2 years or less in my judgment. The interest rates on those, the yields as we call it, if those begin to move upward, then you're probably that's going to put the Fed in a position of having to raise rates. And finally, the risk is the Fed just equivocates. they don't seem to, for a lot of folks out there, business men and women, they get this idea that the Fed may not know what they're doing. Now, I think they do know what they're doing, but they need to be strong. And as Bill Clinton says, even being strong and wrong is rather than being weak and timid. So I think a rate hike should be on taps for the 28th when they announce it, but I'm just not sure they've got that kind of courage. We'll have to wait and see. And thank you for joining us this month. It was a good report. I think we're going to see the economy move forward, and until we meet again, and that will be on November the 2nd. That's the first business day of November, when I, Ernie Goss, report for the Craig School of Business here at Fresno State University. Until we meet again on November the 2nd, may your economic cup runneth over, and thank you.